Let's talk ETFs. Think of them as baskets of stocks. They let you invest in a bunch of companies at once. This spreads your risk. ETFs trade on stock exchanges, just like individual stocks. You can buy and sell them throughout the trading day. Mutual funds are similar but different. They are priced once a day. ETFs offer more flexibility. Now let's meet the companies behind these investment vehicles. Three giants dominate the ETF world: BlackRock, iShares, Vanguard, and State Street Global Advisors, SPDR. They manage trillions of dollars for investors. These companies don't just create ETFs, they decide what goes in them. This gives them immense influence. Think of the S&P 500. An ETF tracking this index will hold shares in all 500 companies. But these firms don't stop there. They are active shareholders. They vote on corporate matters. This impacts how companies are run. Creating an ETF is a multi-step process. First, a company identifies an investment strategy. This could be tracking an index, focusing on a sector, or aligning with ESG principles. Next, the company selects the assets. These could be stocks, bonds, or other securities. The chosen assets form the ETF's portfolio. The ETF is then registered with the Securities and Exchange Commission, or SEC. Shares are listed on a stock exchange. Now, investors like you can buy and sell them. But how do these ETF giants make money? Let's dive into that. ETF providers aren't passive bystanders. They become major shareholders in the companies they invest in. This ownership grants them voting rights. This power can be used to influence corporate decisions. They might push for more sustainable practices or better governance. However, this influence also raises concerns. Some argue that these firms hold too much sway over corporate America. It's crucial for investors to understand this dynamic. Your money is fueling this influence. The price of admission: understanding ETF fees. Like any business, ETF providers need to make a profit. They do this by charging fees to investors. These fees are generally lower than those of mutual funds. This is a key advantage of ETFs. However, it's essential to understand how these fees are structured. There are two main types: expense ratios and trading costs. Let's break down each type. Expense ratios: small fees, big impact. The expense ratio is an annual fee charged as a percentage of your investment. It covers the ETF's operating costs. For example, an expense ratio of 0.1% means you pay $1 for every $1,000 invested. This fee is automatically deducted from your returns. While these fees might seem small, they can add up over time, especially if you're a long-term investor. Trading costs: navigating the buy and sell. Every time you buy or sell an ETF share, you'll incur trading costs. These are brokerage commissions or spreads. Commissions are flat fees charged per trade. Spreads are the difference between the bid and ask price of an ETF. These costs can vary depending on your brokerage and trading activity. It's essential to factor them into your investment decisions. Some ETF providers engage in securities lending. They lend out the underlying securities in their ETFs to other investors. This generates additional revenue for the ETF. These earnings can help offset the expense ratio. However, securities lending comes with risks. If the borrower defaults, the ETF could experience losses. The sheer size of ETF providers gives them significant influence over corporate governance. They can use their voting power to push for changes in company policies. This can be a positive force. They might advocate for increased transparency, sustainability, or diversity. However, concerns exist about conflicts of interest. These firms might prioritize their own interests over those of individual investors. Many ETFs are passively managed. They aim to track a specific market index like the S&P 500. This approach offers several benefits. It's low cost, transparent, and provides broad market exposure. However, index tracking has limitations. These ETFs will never outperform the market, they merely mirror its movements. The ETF landscape is constantly evolving. One notable trend is the rise of ESG and thematic ETFs. ESG ETFs focus on companies with strong environmental, social, and governance practices. Thematic ETFs target specific investment themes like renewable energy or artificial intelligence. These ETFs allow investors to align their portfolios with their values or capitalize on emerging trends. ETFs have revolutionized investing. They offer diversification, flexibility, and low costs. However, it's crucial to understand the inner workings of these investment vehicles. Be aware of the fees, risks, and potential conflicts of interest. By being informed investors, we can harness the power of ETFs while mitigating potential downsides.